I'll now move on to talk a bit about the methodology that we've used in the majority of our analyses. The methodology is based on UCube, which is a proprietary upstream database, which holds more than 65,000 upstream assets. And this picture is a snapshot from the UCube, which shows resources globally. And what the chart tells you is the size of the resources in each area for each asset. The size of the resources are represented by the size of the bubble, and the color represents the geographical region which that asset exists in. For instance, if we look towards South America, we see all the assets in green. That represents the South American assets. And for each asset in this database, we have information on resources, costs, and the tax regime. And this database is a bottom-up database, meaning for each asset, we can aggregate to look at information on either a field level, a company level, a country level, or even analyze things on a global level. And where do we source our data that goes into the UCube? We have quite a few sources of information. Some of them include E&P reporting, so we look at what companies are reporting through press releases, investor presentations, and annual reports, and we include that data into the database. We also look at government sources, and we are able to track information in this regard on an asset level. We also look at what the oilfield service companies are reporting in terms of what contracts are being made, and this reflects the activity and spending on a field level. Additionally, we look at nonprofit organization and academic research, as well as news articles, and in many cases, where there's information that's not available, we have to make analyst estimates, or we use our proprietary code to model this information. So, as I mentioned before, the building blocks of the UCube database is an asset. And an asset can be in different things. It can be a discovery, it can be a field, it can be a license. And we have four main attributes to each of these assets, the first one being resources. And in UCube, the resources represent economically recoverable volumes. And this is the product of the hydrocarbons that are initially in place multiplied by the recovery factor, which is how much they expect that is able to come out of the ground. And if you look at the first chart on the right, you see that we have the resources for one of our fields in Norway called the Johan Sverdrup field. And what you see there is that the total resources amount to 2 billion barrels of oil equivalent. And the resources in this case are split in terms of hydrocarbon phase. So we see there is crude, condensate, and NGL in this field. And the majority of this resources is attributed to crude oil, which is around 1.75 billion barrels of oil equivalent. Secondly, we also look at production. And production is a function of the resources, the facility type, and the hydrocarbon content. And this is generated for each hydrocarbon. If we look to the second chart, we see the production profile for the same Johan Sverdrup field. We see here that production comes in around 2020 and builds up towards plateau in 2022 and produces at that high level for a while before declining. So, thirdly, we look at the economics of the field. And the economics of the field includes things like the revenue generated from the field, which is a product of the price of the hydrocarbon as well as the production. Secondly, we look at the Capex, which is the capital expenditure that is required to develop the field. And the Capex is a function of the facility type, water depth, and number of wells to be drilled. So the more complicated the facility and the deeper the water depth, you tend to have a higher Capex associated with those assets. Then we also look at the operational costs, which is the cost to keep the field in production. And this also includes things like transportation, transporting the hydrocarbon from the field to the pricing point, which is the upstream transportation. And also in this segment, we look at the abandonment costs, which is the cost that is required to decommission the asset after it has finished producing. And finally, we look at the free cash flow, which is all the revenues going to the companies operating the assets. And finally, each asset is attributed a valuation. And this is basically the present value of the cash flows, and we discount these values by 10% in order to come up with the NPV. Moving on now, I'll talk a little bit about the activity we see going forward for Guyana, as well as some information about how the discoveries in Guyana compare to other countries as well. So we all know that the exploration success rate here in Guyana is quite high, at around 80%. This is very high compared to other offshore regions. Globally, the exploration success rate is around 35%. And for frontier regions like Guyana, that rate is even lower at 20%. So the rate here in Guyana is quite impressive. And this chart shows the Guyanese discoveries, how they compared to other discoveries in the world between the period 2010 and 2018. So what we are looking at, the numbers represents the barrels of oil equivalent discovered within that time frame. And what we've seen is that in that time frame, Guyana ranks as the 12th in terms of the highest resources discovered. So it's doing very well as a newcomer into the industry. And we have estimated around 3 billion barrels of oil here in Guyana. And we see that the second highest country, being the US Gulf of Mexico, is around 1 billion barrels behind Guyana within this time frame. All the different colors on the Guyana bar represents the different discoveries, and it shows how much volumes are attributed to each of these discoveries, which we'll go into in some more detail in a little bit. What I've also looked at is just looking at a metric, offshore oil barrels per capita for countries across the world. And what we see is Guyana ranks highest in terms of this metric, with 3,900 barrels per person remaining in the ground currently. So this will represent an enormous wealth to the Guyanese people, and it should be treated right in order for everyone to benefit from it. We at Rystad Energy track all the discoveries in Guyana, and what we see here is a map showing the location of all the discoveries, which is the Stabroek block. And the size of the bubbles on the chart represents two things. Well, represents the size of the resources, so you can see which ones are bigger compared to the others. And in addition, we also see the life cycle of the discovery, so of the fields. So what we see is that most of them, with the exception of Liza Phase 1, is currently in the discovery phase represented by the green bubble, whereas Liza Phase 1, which has been sanctioned and is currently under development, is represented by the yellow bubble. And all these discoveries are in one block operated by Exxon in partnership with Hess and CNOOC. This shows how we attribute all the resources in Guyana to each of the discoveries. So Liza Phase 1 and Phase 2 combined will represent about 1.1 billion barrels of oil, and this has been widely communicated in the public. So we use that information to input that into our database. We have Payara, Snook, Ranger, and Longtail in the region of 300 to 400 million barrels, and Pecora and Turbot being much smaller discoveries. In total, the resources that have been reported is around 3.2 billion barrels. Here we see a summary of the Stabroek discoveries, including information about the development concept, the estimated approval year, which is our own Rystad Energy estimated approval year, as well as our estimated startup year. We also look at the break-even price for each of these assets, and the break-even price represents the oil price at which this asset will break even. So you need basically this oil price in order for the assets to become profitable. And what we see is that the majority of these will require FPSOs to be developed. Liza, again, is the only one that has been sanctioned, and we expect startup in 2020. And the break-even price for Liza Phase 1 is $35 a barrel. The majority of these discoveries have break-even prices between $30 and $50 a barrel, with the exception of Turbot, which is a smaller discovery. And because we assume it's going to be an FPSO, it has a quite high break-even price compared to the others. However, if this could somehow be developed by a subsea tieback, then it would have reduced the capex a lot and improved the break-even price substantially. On the right, we also see information about the resources, as we have seen in the previous slide. We at Rystad Energy expect that Liza could potentially be, Liza Phase 2, could potentially be approved next year and potentially have a startup in 2023. The others will come on sometime, hopefully, post that. And with all these discoveries, we see that Guyana has the potential to emerge as a major upstream destination for oilfield services. What we have projected is that the Capex and OPEX for all these discoveries in the Stabroek block, we expect that it will reach about $15 billion. And this is as a result of ambitious development plans that will require at least 3 large FPSOs. The second and third ones are expected to be even larger than the Liza Destiny, which has a 120,000 barrel per day capacity. All of these discoveries also lie in deep water, with depths ranging between 1,500 and 2,700 meters. And the distance between the wells is quite significant, with up to 150 kilometers between wells. As a result, significant subsea infrastructure will be required in order to develop these fields. And we expect approximately 60 to 100 wells to be drilled and about 12 to 20 rig years to be consumed in these developments. As a result of this activity, we expect Guyana to rank among the 30 largest nations for offshore services by the 2020s. Moving on now to look at the production. At Rystad Energy, we forecast production profile on a field level, and this is based significantly on the resources. This here is the production profile of the Liza Phase 1 asset in thousands of barrels per day. And what we see is that we expect startup in 2020, and then we have a build-up of 3 years until it reaches plateau in 2023. And it will produce at plateau for 4 years before declining. Even though the Liza Destiny has a capacity of 120,000 barrels a day, we have estimated a bit of downtime, so we've plateaued it off here at 110,000 barrels per day. And we've done this sort of forecast for all the fields and all the discoveries here in Guyana. And when we aggregate all the discoveries together and the potential production that could come from these discoveries, if all of them are sanctioned, we see this chart. So this chart represents total production if all of these discoveries do indeed come into production and are sanctioned by ExxonMobil. And what we see here is that Guyana oil production could exceed 700,000, oh, sorry, wrong side. Sorry, I'll just start over. On aggregating all the production profiles for the discoveries, we expect that production will reach 700,000 barrels a day by 2030. Moving on now to talk about economics. So Rystad Energy analyzes fiscal regimes globally. We have 2 main fiscal regimes in our database, and these are production sharing contracts, of which Guyana falls under, and royalty tax or concessions. And this map just shows the main regimes in different areas of the world, and we see in North America and Europe, we have mainly concessions, whereas in Africa and Asia, we have more PSC regimes. So, the fiscal regime is a key element in analyzing government take. And government take is the cash flow which goes to the government. And in order for us to analyze this, we have a 4-pronged approach to calculating it. So first of all, we assign a fiscal parameter to each of the assets. So we assign the fiscal regime applicable to that asset. In the case of Guyana, the main elements here are 2% royalty, which is on gross revenue, and we have a profit oil split between the companies and the government of a 50-50 ratio. There are also a few allowances which are used in the calculation of the profit oil, and these include depreciation of the capital expenditure on a 5-year basis, as well as a cost recovery ceiling of 75% of gross revenue. Secondly, we look at the cash flows for each of the assets. And in this chart, we're looking at the cash flow for Liza Phase 1, which shows all the operational costs, the investments, which is the Capex, and the revenue from Liza Phase 1. And we take all this information into consideration when estimating the allowances that we can use to deduct in order to calculate the profit oil. And in calculating the cost oil or the allowances, we take into consideration depreciation and the cost recovery ceiling. And the chart at the bottom here shows us how we calculated the cost oil profile for Liza Phase 1. So let's just start off by seeing what costs are able to be deducted. And these are all the Capex costs, and that is your black line. Secondly, we have to make sure that we are not exceeding the cost ceiling, which is 75% of the gross revenue, and that is the kind of greenish line. And thirdly, what can actually be deducted is the purple line, which shows you how much is allowed to be deducted. Also, what's interesting is that you notice that the purple line is 0 until 2020. This shows that your deductions cannot be made until production starts. So this has an impact as well on the economics of the field. Fourthly, we calculate government take. And this basically is your revenue minus your royalty minus your costs. And this profit oil is split on a 50-50 basis between the government and the companies. The total government take is then the sum of the royalty plus the government profit oil. So that is the entirety of the sums that go towards the government. And on the fourth chart there, we see the expected government take for Liza Phase 1 in $1 billion. And we see the sum of royalty and government take could reach up to $1.4 billion in the 2020s. This is quite an interesting chart. I should just start off by telling you that the assumptions that were made behind this chart includes a $70 per barrel oil price, as well as we assumed here again that every single one of those 8 discoveries are going to be sanctioned. So in the event that those things do happen, this is the revenue that would be generated from E&P activity in Guyana. And we see this could amount up to $20 billion by the 2030s. I'll just explain to you the different colors and what they mean. So at the bottom, in the green, we have the cash flow, and that is what actually goes to the companies who own this field. Then in the brown, the lighter and darker brown, that is what goes to the government. The yellow and the darker green is what is costs for developing the field, which includes well capex and facility capex. And the purples and the reds and pinks there are your costs, operational costs. So when you sum all of these items together, you get the revenue for the field. And under the same assumptions here, we are looking at the yearly profit from the activity here. And we see that this profit, split between both the companies who operate as well as the government, could reach $15 billion in the 2030s. So basically the take home for both the companies and the government could reach $15 billion by the 2030s. So there's quite significant wealth to be had from the activity here in Guyana. And if we sum all those revenues, all the government take, so all the royalties and all the profit oil from that activity under a $70 per barrel oil price, we see that total government income from Guyana upstream activity could be in the region of $100 billion US. If we look at that under a $90 per barrel oil price, we expect to see it reaching up to $160 per barrel. $160 billion. And if we look at it under a low oil price scenario, say around $50 per barrel, we expect $50 billion to go to the government over the entire lifespan of these fields if they are all sanctioned. I thought this next slide was an interesting metric to do. So what I've done is taken the same information that I've previously shown you, the total government income, and divided it by the population of Guyana to show how much income per person, basically, the government will receive. And what we see is under a $70 per barrel oil price, each person will have $125,000. Moving on now to the fiscal regime comparison. What we've done is compared Guyana's government take with other offshore regions. And we define government take here as the net present value of the government receipts divided by the net present value of the profits of the entire field. And what we've seen is that average for offshore is around 80%. And Guyana comes in at 59%, which in the grand scheme of things looks like a low number. However, we need to take into consideration that Guyana is a frontier region and compare it with other offshore regions that are in a similar state of maturity. And some examples are those in the darker gray, like Mauritania, Mozambique, Israel, Falkland Islands. And what we see here is that within this frontier region bucket, we see the average government take here being between 45 and 70%. And Guyana falling at 59% is quite average in that respect. So we think the regime here is quite fair and average in terms of the fact that Guyana is a frontier region, and we do need to compare it with similar countries. In addition, the reason why these frontier regions need to have a more attractive fiscal regime, it's because we need to incentivize people to come and invest in a region that is quite high risk. So one main way of getting people to do that is by the government offering fairly favorable fiscal terms. And as you can see, it has been successful in attracting Exxon and its partners into the region and discovering all of these resources. Another method of looking at the attractiveness of the fiscal regime is comparing it to other offshore regions by looking at different KPIs. So in this slide, what I've done is taken the Liza Phase 1 asset and run it through our models for different countries, such as Norway, UK, Falklands Islands, Brazil, and Guyana. And I've calculated in each instance the net present value, the break-even price, the internal rate of return, and the payback year. And what we've seen is that the United Kingdom provides the best metrics. So that is the most favorable fiscal regime and most attractive. You might wonder, why is the UK a mature region having such an attractive fiscal regime compared to the frontier regions? But it's because UK is kind of on the opposite spectrum to Guyana, where it is so mature and the resource base is diminishing that the government has improved the fiscal regime quite substantially over the last few years in order to keep attracting investment. And they have been quite successful in doing that. And we've seen in recent years a bit of an uptick in the UK activity because of this improvements in the fiscal regime. We see also Falklands Islands providing quite favorable KPIs. And this is as expected because this is a frontier region and they would be using attractive fiscal regimes to incentivize investment here. Guyana comes in third behind Falklands Islands. And then we also have Norway and Brazil not providing as good KPIs compared to the other regions. And this is because they have harsher fiscal regimes which have significant negative impact on project profitability. The chart on the right shows the cumulative free cash flow for Liza Phase 1 at flat $70 a barrel. And you can see that the best, Falkland Islands and UK, is at the top, and then the Guyana is third, Norway coming fourth, and Brazil being the worst. So I decided to look at what have previous countries done, frontier countries done, when they've recently found oil. Have there been changes to regimes, and how has that impacted investment? So one example we had was in Norway. Ekofisk is a field that was discovered in 1969. It was the first commercial discovery in Norway. And post that discovery, the fiscal regime was changed. And this was driven by an increase in oil price. Because of this, the government introduced a petroleum tax at 25% on an existing contract. The operator at the time was not happy with it, obviously, and since that time decided not to acquire further licenses in Norway in a way of protesting the fact that they did not accept the change, really. So the moral of this is that changes in existing contracts can serve to disincentivize activity. And what we see could be the result of this is major players who have significant capital to invest may disregard that particular country and possibly delay potential future developments because of changes in existing contracts and them not having confidence that governments will keep to their word with their contracts. Another example is the Brazil pre-salt. In 2010, Brazil announced a new licensing system for the pre-salt areas. And the first pre-salt auction post-2010 had only moderate interest. And this reflected uncertainty due to the change regime. Since then, not much has changed with the pre-salt regime. And we have seen good success in 2017 and 2018 with about 75% take-up in offered blocks. And this probably is a result of people becoming more confident that the regime is fairly stable now and wouldn't have many future negative impacts. So confidence in stable fiscal regime plays a critical role in attracting and retaining investment. Both contract stability and sanctity are major considerations for E&P players who intend to invest significant sums and need to realize these returns in a long time frame. So moving on now to summarize, we've seen that the exploration success rates are way above average here in Guyana, and we at Rystad Energy do see a positive outlook for Guyana's E&P activity, with a possible peak production potentially exceeding 700,000 barrels a day by 2030. And this is, of course, dependent on all of these discoveries being sanctioned. We see that Guyana can be a top 30 destination in terms of countries for OFS services by 2020s, with as much as $15 billion in investment to be made. A significant wealth is expected to be generated from the E&P activity here in Guyana, and the government is estimated to receive up to $100 billion at a $70 oil price scenario if all of these discoveries are sanctioned. With regard to the fiscal regime, we've calculated that the average government take here in Guyana is 59%, and this, although favorable compared to offshore in general, is quite comparable to frontier regions. Attractive terms are required in these frontier regions to incentivize investment, and that is because there is stiff competition for investment from other regions, other offshore regions that are a bit more established, and even from shale in the US. We also see fiscal regime stability as a key consideration for the E&P companies when making investment decisions.